Good evening, everyone. My name is Vivek, and I welcome you all to this webinar along with my colleague Kalyan, who is going to take the today's session. And it's a very interesting session because, and it's very mathematical and calculative also. So the people who mess up with the numbers, or the people who often like get jumbled up the numbers, or when they say numbers, they start feeling some kind of a depressed feeling. I think he's going to make all these things very simple. So he's going to take some project selection method. We can also call them project success criterias. So at some point of time, we have couple of projects and we have options to choose one of them. So we employ these methods to select which project is best for us. But many times we are giving the projects. There is no selection process as such. At that time, these methods are used to set the objective and the success criteria for the project. How much financial gain, these both formulas are related to the finance. How much financial gain is expected out of this project, and how much gain will be called successful. There are various methods, and some are very popular, some are less popular, some are popular in particular industry, some are popular in some other industry. And you will find that these methods or these criteria will be very useful to your projects and to create more objectivity and looking for success of the project. Many project managers think that delivering the project product is the success, but not. The actual benefit out of delivering the product is the real success. Otherwise, delivering a product without success does not make much sense, and projects cannot be called successful until the benefits are realized. And that's what Kalyan is going to discuss today. So Kalyan requires no introduction as such. He's been doing this for quite long, more than 30 years, more than 30 years experience. For like you all have seen him taking several webinars, doing several classes on PMP and other. And so has expertise on these methods by practically implementing them and teaching to the people. So Kalyan, it's over to you.
Thank you, Vivek. Thank you for your kind words. So let's start off today's session. Welcome all. And the context has been set, so we will move ahead around what is the topic today. If you recall, many of you attended a session on project value creation by Vivek around 3 weeks ago. Now, if you relate to that, so this is a follow-up of that topic, because he explained to you what is the necessity of value creation, why is it important in a project, and how do you do it. The next step is the challenge for all of us is around what is this value, how do I determine it, and how does it influence my project. That is the topic for today. So before we start, I have a quick poll for all of you. Vivek sir, can you please initiate that poll?
Yes, just a minute. It's here. So there are two questions. One is yes or no answer, and the second is you need to type some answer.
Hope people can see the poll on the screen.
So in the second questions, you need to one-liner, two-liner things. How are you going to address?
Yeah, a couple of more responses would help us.
Okay, Kalyan, I think there is a feedback. Your voice is little low actually. So can you be bit closer to or increase the gain of the mic?
Can you hear me now better?
To me, it is same actually.
Okay. Give me a minute, I'll fix this.
You can go to audio setting and then can change to the volume, increase the volume in the microphone.
I'll do that.
Meanwhile, let the people answer this question, this poll.
Hello. Hmm.
Okay, we will close this poll in another couple of seconds. So please answer it. So
Fix the audio. I'm sure it should be better
yes,
now.
it's better. To me, it's better. So let's see. Like what about Sunil Kumar? Sunil, is it better?
Little audible, sir. Yeah, much better than before.
Yeah.
Okay.
Hopefully that'll be the case.
Yeah, it will continue. Don't worry. Yeah.
Okay. Okay. So let me end the poll, and I will also like share the results. So there are more people saying no, they do not have experience with this, and with respect to the answer of second question, I think we need to look into the this. What is the answer?
Okay, any one of them, whoever answered yes. Did you want to talk about this dilemma?
Focus on
Any one of them will do. You will be help us to relate to it. Anybody wants to ready to talk about their experience around the dilemma?
Okay, let me read out what are the answers we have got. So one is focus on the business problem and assess benefits from the project outcome. That is one explanation. Second is a stakeholder prioritization. And okay, one more is commercial viability. Okay, and that's all. Yeah, that's what the answers I've got.
Okay.
As
That's fine. So commercial
I
viability
stop
is
sharing.
yeah.
I
was
stop
one
the
of
sharing?
Yeah, we can stop this. So basically, a lot of people would like to see how it happens and what is the dilemma all about. Or the other way to look at it is they were not given a choice. They did just executed the project given to them. In either case, it's important to understand what that value creation was or what is the value addition from that project to the various stakeholders. So just one observation here that very often we look at value creation or value addition only at the end of the project. That has been typically all of that what we have been seeing in general. But with the onset of Agile framework and adoption of Agile in delivery, we would see now that this value creation is being measured in multiple checkpoints because of the short iteration in the Agile framework. So have you experienced that? Is the question. Have you experienced?
Sir, this is Atish here. May I add something?
Yeah.
So yeah, I am outside, so I really don't know if you are able to hear me very clearly. So when I meant commercial viability, so I have domain expertise in, I mean, experience in automotive domain as well as in oil and gas. So just an example, when it comes to the automotive, to bid or not bid for a project, that would also be a criteria of what margin you would be getting or what would be your expected margin out of the project.
Right.
So I mean, if there's an order which is 1 million and I'm not even making, let's say 10%, so our company did not even allow us to bid for it.
Right. So that is also part of project management now, because if you remember, we had discussed many times where project managers get involved early in the life cycle. They are not necessarily coming only after the project is done. So this understanding is equally important. Good, you brought it up. So that's what is the commercial viability aspect. Now, many of you may not have been part of those teams where negotiations happen, where bidding cycle, where bidding process is there, where you have to decide about it. Now, in the bidding process or in the negotiation process, there are two scenarios. One, the margins you make or the commercial viability you talk about, the tangible, intangible benefits which you anticipate or envision at the beginning is not happening, or it's not enough to align with your strategic goals. So those are all part of value creation principles we talk about, and then the decisions around, are we generating any value? So today's topic is not about the topic of value creation. Everybody has accepted there has to be value creation. Only then it makes sense to go ahead with the project. Today's topic is about the various models and techniques to determine that value. How do you calculate that value? And how do you quantify, express that in some common denominator? It becomes easier for you to compare. Now, so we paused at a question as to, do you see value creation being evaluation doing across the life cycle in your current scenarios? Is anybody able to articulate that? Are you able to relate to this concept? If you are doing agile delivery, your principles of agile talks about value addition. What is it? Incremental and accretive. That is the model of agile. So every cycle I do, there has to be some value being added and created to what we have already developed. So this is where the concept comes in, where you are relating to that value creation at every stage of the life cycle. Historically, the value addition, the legacy models, if you look at it, the value creation was all measured at the end of the life cycle. When the product is ready, tested, and to be delivered, okay, what value did I create out of this at the end of the project? Sometimes it may become too late for you to do corrective actions if you do this value measurement at the end of the project. That is where now things have changed. Corporate philosophies have changed. You will see the measurements are being introduced throughout the life cycle. It's very similar to the quality principles which we have learned in PMP models, where we talk about quality assurance versus quality control. Historically, quality control was the only thing you talked about. At the end of the product being developed and tested, you looked at it. Whereas quality assurance talks about the entire process, the life cycle. At every stage, you do a check. Where are we? And you take corrective action. So when you look at it in the background, what is needed is to have a reference point with this concept of value creation. So, and it is not difficult to comprehend, because when I say value creation or value addition for a project, it's a huge thing. Can I imagine it to be done only all of a sudden? It doesn't happen. There are various building blocks across the life cycle of the project where you can slowly keep adding value, progressively build on each step as you go along, and you realize the holistic value is represented at the end of the project. Now, interestingly, I have talked about your tangible and intangible benefits. We always end up measuring the tangible benefits, the visible components to us. But if you do a retrospective of your project, of your sprints, of your various phases, you will realize that there have been multiple intangible benefits which have accrued just by that experience. If you ask yourself, do your own retrospection or introspection of the project experience, you will definitely agree that there was a lot to learn. I'm not talking about did you succeed or fail. Just by going through that process of project delivery, each member or each stakeholder would agree that there was a lot to learn for them. So that is an intangible benefit which we don't factor in anywhere. Then what about the spin-offs which you get? The primary goals are there, but then you discover so many things during the life cycle. You add on so many other spin-offs, the residual benefits, the complementary benefits which we talk about. So those are all things which overall add up to your thing.
Something wrong? Hello?
Yes, Vivek. Yeah, I can hear you.
All well, na?
Yeah, all. So today we are going to talk about those various methods and techniques which are available, which are being put to use by various agencies. So there will be some flavor of PMI, there will be some flavor of others also, which are there. I'm just going to list down in this slide a few methods which are there to calculate value. Many of you are familiar with this term called as expert opinion. So what is expert opinion for us? We always believe that you need somebody, domain expertise, and somebody outside to come and do it. Let's not forget that we are also experts in some areas. So if that subject or the domain is in your area, you also become an expert, and therefore your opinion is also equally valued. Now these two things, scoring weight matrix and the ranking scale, are pretty simple techniques which people put to use when you try to evaluate the benefits. Now, what is a scoring or a weight matrix? You identify certain parameters and then you say, okay, rank them as per their importance to you. If it is you yourself and then 3 other people you may call in as experts across. So for example, you may identify the departmental heads and say for this project, what are the relative ranking of the various parameters of the criteria you are identified for the success of the project. Now that would tell you their preferences. This typically we use in our stakeholder mapping exercise. So this is one example of a non-financial model, which quickly you can do. It doesn't take too much time to build this and circulate, get the feedback and collate the results. The second example is about a ranking scale. Now here you do the ranking about the features of the project or the product features which you want to develop. And then you say, okay, what is most important, what is most valuable, what is the MVP component here, which you want to do. In Agile, typically, what do we figure out? How do we start building the MVPs and the MBIs as we go along? So MVP is nothing but most viable, minimum viable product, and the MBI is the minimum business increment, which we add at every iteration. Now, this helps you to build some clarity. So, are we doing the right thing? Is there a consensus among the stakeholders as to what you want? Don't go by certain assumptions that we know the product best. It is better to consult and take that feedback. Now, when do you do this? Not during halfway the stage of the project. We do this early. Maybe you may have to do this exercise in between as the project progresses at different stages. You may want to do it. For example, in a waterfall methodology, your business requirement phase, your design phase, and your development phase will give you surprises as you go along. If people are there here who are able to relate to it, rest assured you will have surprises at every phase of these projects. And you will see you have to realign your priorities. You will have to think about what needs to be done first, and given more importance, you would discover new things. Now, these inputs are going to help you align better with your strategic goal and the organizational goal, what we talk about. What is the value creation from this project? That is the reason we expect you to do this. We suggest that you carry out this exercise, not just once, at every phase. That helps you to confirm that yes, we are aligned, still aligned with what the original goal was, or do we have to fine tune it? Now, there may be some unfortunate incidents where the stakeholder models or the stakeholder mix would have changed by the time you reach around midway of the project. Then that is also another example where you may want to rerun this with a new set of group of people, though they are all in the stakeholder family, but the persons who are individuals who are interested have undergone a change. The third thing is the net promoter score. Now, this is again a fairly popular model now coming up. This is based upon feedback from various stakeholder groups. So you float a question. It's similar to the poll which we did now. It's similar to that. You ask questions about your product or thing and ask them to give their feedback on a scale of either 1 to 10 or 1 to 100 and collate that feedback and make sense out of that data. So the running the poll or generating that input can all be done by PMO. What is important for you? Are you able to make sense out of the data coming out of it? Is it meaningful? Are you able to draw some conclusions and help you to prioritize? So these are some models which are non-financial models. And the number 4 which is listed there is the statistical model. There are good statistical techniques which are available where people use these models to create simulations and determine the most important parameters, the XY parameter, then more complicated things you get the XYZ parameters over the nonlinear and quantum models which you want to simulate. These are generally done for really large projects with a high number of variables around it, and it becomes difficult for you to just comprehend with 1 or 2 parameters what is the top 3 things we should look for, what are the value creation to be. So these are things which we are not going to focus. We just briefly talked about. Now, the important ones we will tell you now about it, discuss about the financial models. Simple reason, because many of you would relate to the financial part of any project and align it quickly with the business value add we talk about. So that's the first one, which is called as a payback period. Now the payback period is pretty simple to understand. What is this payback period all about? It means to determine the shortest amount of time it needs to recover the amount I am investing. Now the amount I am investing could be in the project. Now this is the perspective of the organization. From the organization standpoint, if I am executing a project, it could be your client also here because they are the persons who are spending the money on this project, betting it with you. So how soon can we recover that cost which we are incurring? Now, what is the meaning of recovering cost? What does it mean for you? What are we looking at? A conservative way of working here, thought process here. What is the thing we interpret when we say recovering cost? Can people relate to this statement and this objective, what we talk about? Any inputs?
Recover at least the expenses and a minimum amount of the break, maybe some profit.
Yeah. The break-even point, what you are trying to say,
Okay.
We are talking about break-even point. That is the terminology you are trying to figure out.
Yes.
So what is that break-even point? When can I reach it? So the break-even point you may reach in the project. The question is how fast or how late are you going to reach it? That is the story. So we will see how that has to be done and what we will give you some examples to relate to it. So one of the primary assumptions we do here in this payback period calculation is the revenues or inflows are constant across time. And secondly, largely the assumption is the investment is upfront and then the returns flow. That is one of the assumptions of this model. So we don't factor in additional investments which come in maybe necessary later. So that will then dovetail into the next model, which is our discounted cash flow or the net present value method. So when we talk about the basic assumption of our understanding of payback period, is I am putting up some amount now and what are the returns you expect. Let's not go too far to understand this. Very simple to understand this model. All of you would have had a portfolio which, as an individual I'm talking about, as an investment portfolio, you would be looking at different forms of investment, right? You would have fixed income investment. You would have variable returns like coming up from the stock markets, or you may be investing in house property, various forms of investments which you do. what happens over there? Your expectation is, okay, I will put in some amount now, seed capital I put in now, say maybe 10 lakhs or 1 crore. The goal will be what? Not to make the goal, larger goal is to make money. But the first goal is I should make enough to just cover my cost. At least that should come up. I should be able to recoup that investment first. So that is the principle here. When we say the recovering that cost which I have put in. So how soon am I able to do it? Why is the time element important here? Can anybody explain? Why is the time element important here as to how soon or how later you are going to get it? Sorry, we can't hear you.
Yeah, can I answer that?
Yes, yes.
Am I audible?
Yeah, you are audible now.
Yeah, time limit is important so that we do not incur additional costs and we can recover whatever investment is done and maybe lead towards the profits as well.
Okay. So good. Somebody else also has added a good point. The money will lose the original value after some point of time, and the earlier you reach the break-even point, the faster you move on to new products. Correct. So everybody understands that there is a time element to money. So all of you appreciate the fact that the power of money, what you see today, is not the same 1 year down the line, not the same 2 years down the line as we progress. So that is the primary assumption here, what is happening here around it. That's why your goal is to recover that cost as early as possible, and you are covering your investment. So how does this work? We'll give you a simple example to highlight this thing. I hope you have understood what I mentioned about the time periods here. It could be measured in days, weeks, months, depending upon your project. You may look at it up to what timeline you are measuring, but you need to be constant in that. That's all. Because you can't say first month I will measure in days, then I will jump on to weeks or years. That will not work. You have to agree upon a, just like our sprint, your 3-week model, 4-week model is the same way. You'll have to decide what is it you want to measure in terms of its time part. Okay. So I have given you just a simple example to understand it. Investment I'm making is of 10 lakhs, and my expected inflow, that is the revenue being generated from this investment, is expected to be 50,000 per month. So the way to calculate the time period here, payback period, would be divide this investment by the amount of income I'm expecting every month, a constant flow. So it gives me a result of 20 months. Now in 20 months, I'm going to recover my cost, and then it will become cash positive from the 21st month. Now what is that cash positive mean? Negative. That is the net thing. That means I would be earning more than 10 lakhs after the 21st month. Till 21st month, 20th month, I am interested in replenishing my investment which I have taken out of my whatever kitty I had. I'm trying to recover. Now, if this is a large amount, you can take any small example, you will be able to relate to this. And this is common sense. This is what we do. Even as individuals in our family life also, this is the approach we try to do. How quickly can we recoup the investment? Somebody has brought about the concept of depreciation here. Now, the depreciation meaning here is about the apparent loss in the value of that asset. That's what is the meaning of depreciation. So let's not, there are other topics which we can get into when we get into depreciation, asset erosion and all that. The goal here is to understand what is the principle we apply when we talk about a payback period. So often what happens as a vendor, now where does this apply to us? Why are we talking about all this? If you are playing the role of a customer, you should understand that the investment I'm talking about is the outgo, because you are going to pay your vendors certain amount of money to execute the project. So the goal for you is how early can I start making it product viable? The product is put to use. How soon can I commission the project so that it starts generating revenue? That is one aspect. Now switch your role. If you are the executing team, the person, the project who is as a project manager, You are delivering this project to a customer. What happens at that point of time? How many times do you get advance payments for your projects? I think in today's scenario, you will be lucky if you get some advance. So you have to also put in some amount of money. You have to also achieve certain milestones in your project. You have to demonstrate that to the customer. Yes, this is what was promised and this is what we had agreed and delivered. And only on approval you get that money. So this is what is your payback period model which you are talking about. How soon I am able to do it? How soon I am able to generate that invoice and can get that money? Now that money I can recycle back into the project. So this is all about cash flow management for you. If you don't get that money at that milestone, you have to invest or spend a lot more till you reach the next milestone and generate further money. So this example will help you to understand those models for you, how quickly you can get it back. Take your own credit card limits example. What is the credit card limits tell you, basically? Anyone? You are issued a credit card and you are given a limit to spend. What does that signify to you?
You cannot spend beyond whatever is the limit set for you.
That is understood, but that limit is there for you to spend, right? So what happens? Is that vendor not taking a risk with you by giving you that freedom to spend money up to that level? What is the guarantee they have? Have you given any guarantees against that credit card? Nobody asks for that guarantee. They check at your credit score and then they determine that this is the limit you will be enjoying and you can spend that money. And typically, what is the life cycle of every billing cycle? You will see 45 days. If you are using your money wisely, you will see it's a 45 days life cycle you can have. So that cash flow is what that guy is factoring it at his end when he is allowing you to spend that money. That is that investment he is putting in, no? On your behalf. You are not spending your money, you are spending somebody else's money. Then you are paying it back after that 45 days. So I'm just telling you to take a look, not from your perspective, from your banker's perspective. What is the risk he is carrying? Why is he taking that risk? What evaluations has he done about it? And where do you think he is earning money? Does he earn money from you? By giving you that credit? How do the banks earn money then on your credit card? Banks earn money from your merchants. The people, wherever you use your card, those merchants have to pay a fee to the bank. That is how they earn their money. So we just gave you some scenarios here where you can put to use. So multiple period projects, because duration is a factor here, and constant revenue and inflow is what is one of the primary things you look for when you do this payback period. So examples, you can talk about your housing loan, car loans, education loans. That's what you try to do. You try to do this from a different scenario, because for you, the cost it's taken is as a cost, not as a revenue. But for the person who is giving you that money, that is the revenue there for them. So this is where you can simply, this is a very simple technique to put to use what is called as a payback period. Only one of the problems you will see here is if the inflows are changing or variable, then it's not easy to apply this straightforward technique. Now, the second challenge you see here is the constant value of money is what is assumed in case of a longer duration. For example, your housing loan, which is 10-year, 15-year payback period. It's difficult to propose like this because you're not factoring the value of the time loss of money, which many of you talked about at the beginning when we talked about this topic. So this method doesn't help you, but this is a quick turnaround you can get by doing this calculation, and you can easily come to a number as to what should be the target you should be looking for. Even if your organization has not shared those data, this can be easily worked by you around it. Assuming you know the revenue propositions of your project. I assume some of you may not be even privy to the revenue models of your organization, of the project, then it is difficult to talk about. So we advance to the more complex model called as the net present value, also known as the discounted cash flow. Now, what was the disadvantage we talked about there is the value of money over time is not factored in. Money loses value over a period of time, because we have seen historically that has been, I have not come across a scenario where money gains value over a period of time. I have not come to that scenario yet. If you have, please help me. Right now, what I have seen so far historically has been that money's value erodes over a time. It could be 3-year, 10-year time, 20-year timeline. Value of money has only eroded, not improved or appreciated. What has appreciated? The value of gold, the value of your investments have appreciated. Why is that so? Simply because the underlying, the denominating measure, which is the money, whatever currency you call it, the value of that money has gone down, hence the value of these assets are seen as appreciated. So the objective here is to do a projection. We carry out a projection across that time period and say, what is it? But we need to have some data points to do it. So what are those data points to do this calculation? So this is the left side is the formula which we normally use for calculating the net present value. This is a sigma value which you normally calculate. But to make it simple, I have just created a table to help you understand. You can extrapolate this to whatever number of years you have. One of the key aspects in this model is to determine this discounting rate. What is this discounting rate? So we all now agreed at some point of time that the money loses value over a period of time. So the question is, at what rate is it losing value? That is the factor here. We call it as a discounting rate. So simply put, what do you see at what rate is the Indian rupee losing value over the last 5 years, 10 years, based upon your experience? What is the average rate you are seeing? Anybody, individual reading, whatever is your reading of the situation. Because all of you are good in your maths and your money management, you know at what rate things have been going down. It is also called as the purchasing power of money in economics. No answers. Why people are worried about talking about this? Okay, what is the inflation rate you will talk about? What has been the inflation rate in India over the last few years?
It is averagely between 7 to 8, considering all the commodities. But it varies from for each of them.
Yeah. So 7 to 8%. So what does that word inflation translates to you? That inflation means what for you? The same product or the same commodity costs me 8% more next year or this year as compared to the last year. Correct? In general, price rise has happened, and therefore that is what is hurting me. So that is your inflation, what we mean. Okay. Now that is what it in turn translates into discounting for you. Now the best way to understand this is, let us say your salary. If that salary is treated as constant over a 3-year period, but the prices of goods and commodities which you are buying in the market are subject to inflation, so the rates are all going up. So what do you see? Net, what is the result you are seeing? The amount left with you has decreased exponentially over the 3-year period, correct? Because you are buying the same quantum of goods, the same volume of goods you have been purchasing over the 3-year period. On one hand, something is fixed, which is your salary. What has changed? The outgo. The money outgo has changed because the cost of things have all gone up, and that is what we term as inflation. Now you understand the thing. Now I'm going to flip this scenario. If you are delivering a project, now you are going to project this scenario over the next few years. Would you therefore factor the revenue coming in from that project as constant? Even though you are earning, let us say you would be factoring in your contract, I will earn 10 lakhs per month over the next 3 years. Every month I am going to do a billing. Does it translate that 10 lakhs to the same purchasing power of 10 lakhs for you as what you do today versus 10 lakhs over the next 3 years, 3 years down the line? The same 10 lakhs will not be able to give you the same margins 3 years down the line, 36th month or the 37th month, because against that revenue, whatever services or components you are going to purchase and deliver, the cost of those are going up, will definitely go up based upon your past experience. Now, this is the reason why you factor in this cost of money and term this as a discounting rate. Here is where the discounting rate makes sense. I hope you understood now how this, why this is being done and how this is calculated. And so how do I arrive at this number, discounting number? There are multiple benchmarks you could use. One, I gave you a simple example as your wholesale inflation index or the retail inflation index, which is published by the central bank. You could take that. Or between you and the customer, you could agree on certain benchmarks which can be used by both of you, understandable to both of you, and treat that as a fair benchmark. If that fluctuates, your contractual, you can hedge in your contract. That's called as risk mitigation model, where it's also called as the economic value adjustment. That is a contractual term in when you enter into contracts for long term. You can factor in that. If the rates differ or exceed or decrease, the other party is suitably compensated. So those are all principles where you build this scenario. Here you are going to build the scenario at the start of the project. Say I am doing a 5-year project. I want to know what will be the total returns, total amount coming out of this project for me. I will do this kind of a projection. This is done very simply in Excel. So I will try and show you that what I did in Excel for you quickly. So it becomes easier for you to comprehend. You don't have to be an expert in doing all these things. Excel helps us a lot here. I have taken this picture from Excel for you. Here is the number. So I just put this and I have at the bottom I use the NPV formula. I just put some values and I just put the NPV formula at the last. So you could also try this scenario at your end. So that way the tools are available for you to make it work. But what is needed? The ability to project your revenues and your outgoes. In this particular example, I have assumed the outflow is only 1. But in NPV, you can also say at the end of the 3rd year or the beginning of the 3rd year, maybe there is further outflow needed. You want to factor that in, please add. You will feel free to add that line. But all your outgoes will be shown as negative. Your inflows will be shown as positive. Only then you will get the net returns of the project. That's a simple way to showcase this thing. So let me take some questions if you have on this. Anybody wants any understanding, better understanding on this? Okay. Good. So people have understood NPV, how it is done. So again, I don't ask you to sit and calculate these things. Your team will be there to help you. Experts will be there to do it. What is important for you is to decide these numbers, the revenue part and the outgo part. That is what your expertise has to put into place. Your planning has to be really good to decide that these are the flows we are planning, cash flows, in and out. Then your numbers will be more realistic for you. Now, by putting these inflows like this, you can always compare your performances, actual versus planned also, around those periods or across the phases. Now, I put it in a year. Other way to do it is also in your waterfall methodology. You could build phases, or in your agile models, if you are looking at it, based upon your iterations, releases, you can factor this. No problem. This will fit in that model works across all those scenarios. So where do we normally use this? Long-term multiple projects, where multiple inflow and outflow scenarios are there for you. You could do it. And very realistic scenario where varying or constant revenue is considered. Varying, changes in revenue. You don't have constant revenue coming in. You don't have constant expenses also planned. That is where this works. Many of you who are into large capex projects, you would realize this. This is where that happens. This kind of NPV calculations are done. And when I mean multi-year outsourcing, it's meant for all those IT guys. Many of you are from the IT field. You would see as a vendor, you are signing multi-year contracts with your customer. That is all. That is where your organization would be doing this kind of a modeling. Now, the only primary drawback you see here is the having an agreement on this discounting factor. This is what is the subjective element in this particular technique. Now, you may say 8%, I may say 5%, somebody may say 10%. There has to be some agreement here. So, what is the way out? The best way out here is to go by your organization's benchmark. Your CFO is there, the known expert in your organization. They would have come to some agreements when they create their budgets and the revenue projections. What would be this cost of money they have to look at? It's also known as cost of capital at year end. So that this therefore leads to the next model, which everybody understands is similar to called as internal rate of return. So this is where your organization would normally have something called as a goal that we need to pick up projects only which give us a certain rate of return. I will not go and do any project, anything which comes my way. I will not go into it. I would do a filtering model. I'll do the evaluations first and determine what works best. So here is where our friend added something earlier. Yes, Atish, are you still there? Are you able to relate to this? Can you explain a bit more on this? This is what you are referring to. Atish, can you hear us?
Is there probably?
Yeah, maybe he
can
was
go ahead.
driving. He said he was driving.
Yeah, he was driving actually. Correct.
So basically, this is what he was referring to when he said the organizations, when we get into bid or negotiation process, we even first compare the expected returns with our ballpark number of our organization. So first thing is, are you aware of your organization's ballpark? Only then you can drive a decision around it. That is my assumption I have called out here. You should be aware of it, or you should be involved in those things to figure out what is meant. So how does this model work? The principle is the same as NPV. Now the only difference they do here is they have combined the feature of payback period within NPV. So what is the feature in payback period? You recover your investment at the earliest. So determine the time element, how soon you achieve that value of 0. So that is how this is built in your project. So we will show you as an example. So what did we see in the earlier? Let me go back to the earlier slide and again relate to you. So what was the discounting factor we took there in NPV? 6%, and we did this calculation. Now, if I have to do the IRR calculation on this, I have to tweak it to the time element and figure out at what percent my payback period can be determined. That is, the NPV should be 0. So I will do that calculation here. So what will be the discount rate by which this NPV becomes 0? So I play around with this number, keep changing it. This is a trial and error I have done. Kept changing on that same Excel sheet, reduced it, increased it. And then I saw at this point, 8.108%, my internal rate of return becomes close to 0, given this is the period. Now, there are two aspects to it. One is the inflow outflows. You can change this if you want to have a different number, or if you are confident about these inflows and outflows, keep it constant and then just determine the discounting rate. Now, once you arrive at this discounting rate, what you would do? Okay, this project gives me a rate of this. Now, does this fit with my organization's rate of return? Does it make sense? Is what you can compare. So remember, there are two parameters you can influence. One is the period and second is the rate. It's not always a unilateral way of thinking as just one way to do things. So, but from a tool perspective, it's very simple. NPV year in cash flow. Are you referring to this table or sorry, or I'm just referring to question posted on the chat box. The NPV talks about the net present value. So number of years is something which you will have to, which you will be knowing from your contract perspective as to, okay. In the NPV formula, that's a sigma formula what we talked about. I'll go back to you later on that. I'll come back to it. So this is how the internal rate of return calculation is done. Now, to relate to this, let's take our own investment portfolio example. Okay. Suppose let's say this is the appraisal season, you end up with a good bonus from your organization. So this bonus is not factored in your inflow. Now, what is the best way to leverage this bonus which you get? Let's say you get a bonus of 1 lakh rupees. Now, the challenge for you is, how do I make this money work? Idle money is of no use to any of us. So how do I make it work? So you would look at your own investment option, and what would you decide? What is the internal rate of return? That means what is the minimum rate of return which I have in mind, which I can generate? That is what is the first option you would look for. Then I would say, okay, what are the better options do I have? Can I leverage this better? So what is the minimum rate of return? I don't know. You may be having your own benchmarks, could be 7%, 10%, whatever how smart or investment savvy you are with your money. So should I do investments in stocks? Should I do this day trading principles, or should I invest in a mutual fund? All those scenarios you would evaluate. Now, all decisions are driven on this particular parameter, what is called as internal rate of return. So I'm just trying to keep this simple for you by relating to your own examples rather than complicating it with what the organization does or what the finance team does and all that. So this principle is very easy to understand if you can relate to your own experiences, how you do this. Then you decide what is better. So we touch upon the risk management component. Higher the risk, higher the return. So higher risk reward ratio. So if you want to be you want to be more conservative, you may accept some of the lower things, but it is more safer for you. So those are the principles on which you do your calculation around it. The only drawback you see here is you don't focus on the total ROI. The total ROI stands for return on investment. You are focusing on the rate of return, which means on a periodical basis. So the best way to put this across to you is, if you invest in your mutual funds or your fixed deposits, term deposits across either in companies or in NBFCs or banks, the term deposits are all listed as you get 7% interest annually, 8% interest annually, and all that stuff. Now, there is a scenario there. You can get interest annually, quarterly, half yearly, and all that, versus getting cumulatively. How many of you tried that? A cumulative versus this periodic rate of return. What is the difference there? I hope people have understood the difference there. The cumulative versus the periodic return. Anybody wants to add? Or I would end up speaking throughout.
You start getting interest on it, whereas if you take periodic interest, that is not getting reinvested.
Yeah. So you are earning interest on interest. So you are making that money work by reinvesting it. Okay. So periodically,
so investment in short would be higher in cumulative one.
That is why you end up getting better in cumulative. Now, this decision is driven by your cash flows. If you need money regularly, like somebody who is earning a pension, for example, None of you, I believe, are in that mode right now. So if you see your parents or your elders there, they are all focused on that first few days. Oh, yeah, my pension needs to come. Why? Because that investment has been made to give them a periodic rate of return or the periodic reward to them to run their day-to-day life, to meet their day-to-day expense. So that is what is that pension model for you, or the periodic return is all about. The cumulative model is where you focus on the ROI aspect of it. At the end of the term, what is the ROI on it? How much did I earn? So generally, you will see in that cumulative investments, your ROI is slightly always better than the periodic withdrawals which you do in the other models, either quarterly, half yearly. For example, on 31st, if you have invested somewhere, you would get your annual interest or your half yearly interest or your quarterly interest. All of that would have come. So whereas the ROI, that is, if it is cumulative, you won't get that. It will be shown as realizable or payable only at the end of the term or the end of the maturity of that investment. So that is the only drawback here. When you do this calculation, we don't look at it. When organizations do the factoring here using this IRR, we look at the rate of return rather than looking at the total ROI. That is the only difference we are highlighting. Now, the model which many of you would have learned in risk management models, in my view, that can also be used for your project selection also, hence I have put it here, is called as an expected monetary value. Now, this is a scenario which often you see when you are launching new products or services. So when you are getting into a new scenario or new business scenario, what are you going to do? Typically, you are going to carry out projections around three possible scenarios: pessimistic, normal, and optimistic. So that's how we do projections. Okay. You can do more than that, but by default, generally, we'll stick to three scenarios. Pessimistic, conservative area, how much will it look like? Normal business runs, how much returns we would get, and optimistic, how much would you get? So the focus here is on the optimization of that revenue, looking at the total. So here the focus is on the ROI concept. So that is how the story is tied up for you. The earlier things were not focusing on ROI. Here is an example where the focus is on ROI, not on the periodic rates of return. So here is an example which I have just, again, using Excel simply calculated. So a status quo scenario means I am not doing anything right now. I am continuing to live, doing my life, going ahead with my life as it is, or I am not interested in taking up any new project. The other scenario is where, okay, I am ready to invest on a new scenario. How much would it cost? The initial investment, and what are the multiple possibilities I am talking about. First scenario is what? Failure or success. So there is a 25% probability that I may fail and 75% probability that I may succeed. Now, what is the revenue I am expecting out of it? Then in case of failure, how much cost I am going to spend? That is all we are talking about. So in EMV, what do? You look at the probability. So 25% and 75%. Remember the PI model, probability versus impact. So do that product. So the product of these two, 25 into minus 2.5, 75 into plus 6.63. The net of that is the outcome at this decision point, so which is around 4,13,000. So the primary objective for you is all the probability should add up to 100 at that decision point. You may draw any number of branches you want, but the total should add up to 100. So now in case of failure, there is no further things to look at. But in case of success, I am further drilling down, further having talks with my marketing team, sales team, figuring out what will be the percentage probability that we will have a high volume, medium volume, or low volume business. So again, you see that this total should add up to 100. Very important. And if my sales are going to be high volume, what is the revenue I am expecting? So I'm not looking at a revenue as a constant. I'm looking at it as a probability. So the value of that is actual result is here, 5 lakhs, 3 lakhs, or 360. So the total revenue expected is 8,85,000 in case I succeed with these probabilities. Now what this scenario tells me, I am looking at it as a very realistic and more practical approach rather than looking at a constant value, constant revenue, or constant cost. I'm not looking at that. I'm looking at a very realistic scenario. These are how the probabilities would be looked at. When I'm expected to launch a new product or a service, this is what we need to factor in. So now this outcome gets tied up with the factoring here and arrived at this number, and what is the net result out of it. So I see net I am making money. I am not losing money. So it's worthwhile to go ahead this way. Sometimes it is possible that this number may be negative. Then that means that model is not worthwhile. So what message are we getting here in this particular model? Here is that I'm not looking at the constant value. I'm looking at the probability and therefore discounting it. So this is a different way of discounting that constant number. Okay, I'm sorry, I'm exceeding the time. So can we get 5 minutes more from you? Hopefully all of you, we will wrap this up. Is it okay? Yeah, I mean, I assume things are okay for you. 5 minutes, we'll wrap this. Yeah. So this is how the expected monitoring EMV can be done for you. So I'll give you a simple analogy to look at this. Many of you would have cleared your PMP exam. You are all PMP certified now, or some of you are preparing for it. You could try this EMV on that, on your scenario. Let's go back to how you do it. The status quo scenario is I am not upgrading myself. I am not doing anything. I'm happy with what I am, is what in my career I can look at. Now, what could be the new opportunities I will do to upscale my career, to upgrade my career? I could look at certain certifications, to look at new areas. Now, that is one option. So after investing it, am I completing that? Then that is a success. If I am not completing, that is an investment going waste. So that is a failure part. Now, once you have succeeded, what are the paths available for you? Either you could grow in your organization, option one. You could grow outside your organization, or you could start on your own. Multiple options are there. You could then decide the revenue channels you can explore, the opportunities, the probability, and the likely revenue you are going to generate out of it. A simple way to map your own career also, when you want to look at these aspects. So the only drawback, if you see here, the focus is on the return, which we are talking about. Here, the focus is not on the time value of money, nor on the time value of money is considered differently here based upon the probability of the returns which we are talking about, not the factor of money like discounting factor which we talk. And the duration of the project is not factored. I mean, is it a 6-month project? Is it a 24-month project? We don't put that into account, but you need to consider that when you are looking at the scenario. This model doesn't call that out clearly. If you look at the other example, you saw the timeline, time phasing was very important. Here, we don't focus that much on it. So those were the various models which we talked about. And I also came across a good example of a project selection techniques in PMI website. So I will just take a minute to walk you through that, share the link with you. It's already given in this, but I will show you my screen because I kept it open for your reference, and quickly walk you through that and wrap up our session.
Okay.
Just a minute, I'm trying to open up that.
You're sharing something?
I'm opening it up, yes. Yeah. Yes, hope people can see this now. Yes, Vivek, can you see the screen?
Yes, we can see.
Yes, sir.
So this is a case study. Is every business request a project or not? An interesting case study published in the PMI Global Congress by this gentleman, Mustafa. It is available in pmi.org. You can just go search
You
it.
can
You will
share
find.
its link actually in the chat.
I have put it in the PPT itself. It is there already.
Yeah, even the chat you can just copy paste.
Okay, I'll do
Okay.
that. I'll do that. I'll just post it in the chat. So it's a very, it's not a new one, but it's okay. It's an old one, but relevant for our subject. to understand how organizations have implemented the project selection model, and they have developed a methodology also around it. This is a company for which he has taken an example and talked about how the demand management works. So we talked about that project selection dilemma at the beginning. That is what is being addressed here. How you do it, how they have gone about building a model, robust methodology to do the evaluation. So some of you may be in senior positions where you would be taking this cue and looking at it. You might be also doing it. For many of you who are not involved at that level, this is worth a read to figure out how seniors in your organization take decisions about these various project selection. Which project to select, how do we prioritize them, all those models are, this model paper explains it very well. So as I told at the beginning, these are my views. So feel free to tailor it as per your requirements and your business studies. Our goal here is to help you demystify some of these things and make it easier for you in our weekly session. Okay, thank you for your patience, and I hope people benefited. So before we adjourn, a quick check with you. Yeah, good.
I don't think we have much time for question, but still, if somebody has some questions, I think we can address that, right?
Yeah, we are running late today. So only quick check with you. Hope you benefited by this discussion, and we seek your feedback, and your contributions are always welcome to make this better as we progress.
So, okay, yes, I think this is. Thanks for the session. I don't see any question as such.
Okay. So thank you all, and look forward to the next week's session again. Another new topic for all of us.
Thank you very much, and see you next week, and help us to reach out to more people. Please share the link of this webinar to your friends and your colleagues so that more people can join this program and we can reach out to more people actually. So thank you very much. See you next week on Tuesday, 8 p.m. Bye-bye.